Hello, this is Kath Hall and welcome to this eCPD module. This is the first of two modules on income tax losses, and this first module will look at the basic rules for the use of trading losses by a sole trader. Whilst not preempted on the previous screen, and neither on the chevrons at the top of the screen you're looking at now, I've put here a summary, hopefully a useful checklist of the loss reliefs described in this module. The offset of losses against income, then gains, then the special opening and closing year rules, and then finally the carry forward. The details of quite what loss can be set against which type of income or gain will be described in the following screens. Just so you know, the offset of income in the same tax year and against gains in the same tax year and or the one before is often described as sideways loss relief, where losses are poked sideways against general income. An adjustment of profits for a business and the deduction of capital allowances may result in a loss rather than a profit, and that loss is assessed in a tax year using the same current year basis of assessment as for profits, the assessment, the amount taxable, being nil, clearly. But then the loss of that tax year is available for loss relief. I'll talk more about the cash basis later. The first loss option is shown here, the offset of that loss against income, other income before the personal allowance in the same tax year of the loss and or income of the preceding tax year. You'll see there that either claim can be made, one or the other, or both of them, and if both, in any order. To reiterate, this first loss relief is flexible in terms of the tax year in which the relief is available. However, the amount of the trading loss that can be offset cannot be restricted in any year. Whilst the taxpayer can choose the order of claims, the amount of relief cannot be restricted, for example, to preserve the personal allowance in a particular year. However, with differing tax rates and bands, the order of the claims made may be optimised to save as much tax as possible. I say tax, income tax, but there is a knock-on effect with regard to relief against capital gains, which I'm coming on to. This sideways relief, I don't really like that phrase, but others do. This sort of pushing sideways of relief against income in other years is not available if the cash basis is used. This first example reiterates the flexibility of the claim, so the loss for 2018 of 40,000 can be the subject of a claim in that year and or the one before, in any order. There are some following screens on capital gains tax and a loss relief claim, as you'll see in a moment, for the loss against gains can be made in those same years following a loss relief claim against the general income shown on this screen first. The gains claim piggybacks on the claim against income. Following on to capital gains, a trading loss may also be set against capital gains in the same years as described on the previous screens with regard to the loss relief against income. As I said before, this relief essentially piggybacks on the reliefs against general income. If a claim for that relief is made in one of the relevant years, then the remaining loss may be offset against capital gains in that tax year. Having identified the relevant years to use a trading loss against gains and identified that that's the same as those years available for relief against general income, then the amount of loss relief available against gains must be determined. This is essentially the lower of two figures, what's called the relevant and the maximum amounts. The relevant amount is the loss that remains after the necessary relief against general income that has to happen first, or indeed any amount that's already been used in another tax year, so what's left over. This relevant amount, the amount of the loss left, is then compared to the maximum amount. The maximum amount is described on this screen in words, but imagine it as a calculation of essentially current year gains, less current year capital losses, less capital losses brought forward, regardless of whether they are actually used. Compare the two, maximum to relevant, take the lower as the amount to be converted from the trading loss to be used as a current year loss and set against capital gains. Partial claims cannot be made, but that is true for all of the loss reliefs we've been describing in this module. Just to make a comment about the annual exempt amount, that's ignored in the calculation of the maximum amount, but obviously will come in the final CGT liability, where actual brought forward losses can be and are restricted to preserve that annual exempt amount. On to loss relief in the opening years. The normal loss relief that I've just described are available in the opening years against income and gains. However, losses in these opening years will be computed according to the current year basis opening year rules. So, for example, on an actual basis up to the 5th of April in the first year. And then depending on the length of accounting periods ending in the years following. Those figures will define the losses of each tax year, and those of the first 4 tax years can be the subject of the extended carryback that's being described on this screen. To continue, here are the actual details. A carryback of any trading loss of these first 4 tax years of trading may be made. The carryback is against the income, the general income, total income of each of those years. But the carryback is essentially on a FIFO basis. It's a bit strange. It's back to the earliest of the years first. But once the claim has been triggered, the loss is then used against all of the subsequent tax years. So it just washes through all years, I remember before personal allowances, until the loss runs out or all the profits are extinguished. I say profits, general income means, for example, if you used to be employed and you set up your own business, we're going back to when you had maybe large amounts of employment income, or maybe had large amounts of money in the bank earning interest and you used that to set up your business. All of a sudden you've got losses to carry back to extinguish those items of income in previous years. Tax back. Here is an example of the opening year loss relief rules for Henri, who started trading on the 1st of January, so his first tax year will be 2017-18. I've made his accounts to be prepared to the 5th of April, but that's fine and not uncommon. The loss for 17-18 may be the subject of a claim against total income of that year and or the preceding year. He might have been employed the year before, enjoyed savings income the year before, and so that may be helpful. It may also open up a capital gains tax loss relief claim in those 2 years. And then there are the opening year loss relief rules, which allow this loss of one of the first 4 years of trading, which happens to be 17-18, to be carried back against, again, income of 14-15, 15-16 and 16-17 in that order without any restriction to the amount. Back in, 7 or 8 years ago, I'd be talking about looking at the carryback and changing income tax rates. Not so much now, but equally looking back to see what other reliefs have been made in those years, what the profile is of general income, and whether the carryback is a good idea, makes loss relief interesting. And to the last loss relief in this module, terminal loss relief, or loss relief in the closing years of a business. This is a relief that applies to a loss incurred in the last 12 months of trading. So we're departing from the tax year and the current year basis assessment rules here. In essence, there is the availability of a 3-year carryback of this terminal loss, trading loss, on the cessation of a business. However, the loss is not calculated, as I mentioned, in accordance with the CYB rules that apply to the previous loss reliefs described in this module and identify the tax loss for a tax year, but according to a specific calculation of the loss of the last 12 months of trading. As mentioned on the previous screen, there is a specific calculation of the terminal loss that is available for this essentially carryback relief. The loss of the last 12 months to the date of cessation of trading, but the calculation is split between A, the amount of loss in the final tax year, and B, the amount of loss that falls in the penultimate tax year. Now this may involve apportionment calculations. I've got an example at the moment, but the two calculations in A and B are separate. Again, I'll refer to that in a second. Following on from the previous screen, back to apportionment of losses and profits that may be needed to arrive at the figures for A and B. But this is done separately for period A and B. An overall profit for either A or B is disregarded in arriving at the final terminal loss. And lastly, overlap profit is deducted from the available loss of the final tax year, period A, to arrive at the terminal loss available for relief. However, some of the loss may have already been offset against profits to arrive at an assessment under the current year basis rules for the final or penultimate year. That loss used in aggregation with profits is not also available as part of the terminal loss. This example hopefully will help and shows the calculation of the loss in its component parts, A and B. I've put C on the end, which is the inclusion of the overlap profit, but come back to that in a minute. In part A, the terminal loss is the part of it from the 6th of April to the date of cessation, the 30th of June. Again, time apportionment. And then the balance of those 12 months is part B. There's a bit of profit and a bit of loss. Apportioning them, it comes out to overall a profit, but that's just disregarded, hence I put nil in my sort of total column. I've dropped the overlap profit at the bottom, £3,000, a negative figure, so the terminal loss is £7,500. That's the amount that's available for the carryback. For the purposes of other loss reliefs, which are available, the loss for 2018-19 would be the £9,000 for the period, 6-month period ended 30th of June, plus the overlap, so that would be 12,000. But obviously losses can't be used twice, so any correction would need to be made depending on the order of the claims. And finally, once those claims are made, or not made indeed, a trading loss may be carried forward and will be carried forward and set against future trading profits arising from the same trade. Once again, no partial claims are available. In fact, that's true for all of the loss reliefs we've looked at, and the loss is set off year by year without skipping over any years. This is also the loss relief available when the cash basis of computing trading profits and losses is used, because sideways loss relief, you know that phrase I don't really like, but setting losses against other income in different years is not available. The key things to remember from this module are that there are a variety of loss relief options, including particular carryback options in opening and closing years. In addition, losses may be set against gains in certain circumstances, and as a default, carried forward losses will be set against future trading profits. This will all result in savings of income tax and capital gains tax in current years, future years, previous years, so it makes for an interesting exercise in determining the correct loss relief option choice. I trust you have found this first module on income tax loss reliefs informative. Goodbye and thank you for using Croner eCPD.